Part 1. The Seeds of a Legend. The story of Peter Lynch does not begin among the skyscrapers of Wall Street. It begins in the quiet, uncelebrated corners of everyday America, with a boy who sold newspapers, carried golf bags, and studied the world one small observation at a time. But few could have predicted what would follow. Because in just 13 years at the helm of a single mutual fund, Peter Lynch would achieve something so extraordinary, so unmatched, that it still stands today as the defining standard of what professional investing can be. A 29% average annual return, year after year, quietly, relentlessly, compounding with the patience of a clockmaker and the precision of a surgeon. He turned a modest mutual fund into a financial legend. He built wealth not from theory, but from understanding, true understanding, of how people live, shop, work, and dream. This is the story of how he did it, and what his rise reveals about intelligence, luck, fear, faith, and the American economy itself. Origins: a childhood shaped by uncertainty. Peter Lynch was born in 1944 in Newton, Massachusetts, during the last year of World War II. The world around him was rebuilding, redefining itself, but his own early life held hardship and uncertainty. When Peter was 10 years old, his father died of cancer. This loss didn't just change the emotional fabric of his family, it changed their economic reality. His mother, suddenly a widow with the responsibilities of providing for a household, took on multiple jobs. Peter watched closely. He learned the value of labor not through lessons or lectures, but through the quiet exhaustion of a parent doing whatever it took to stay afloat. It was here that a foundational belief began to form within him. Money is not just numbers. Money is security. Money is independence. Money is possibility. This belief would stay with him for the rest of his life. The golf course. An unlikely classroom. As a teenager, Peter Lynch did not spend summers in leisure. He worked. He found a job at the Braeburn Country Club as a caddy. For most, caddying is a task. Carrying clubs, watching shots, earning tips. But Lynch saw something others didn't. He observed the conversations. He noticed the types of people who belonged to private clubs. He noticed what they talked about. He was surrounded by business executives, investors, and financiers. He learned how wealth sounds when it's relaxed. How decision-making reveals itself when people are not aware they're being listened to. On that golf course, Lynch discovered what would become his guiding approach to investing. Real life is a better teacher than theory. The world is full of clues, if you learn to look. This idea would one day be summarized in one of the most famous phrases in investment history. Invest in what you know. An unexpected opportunity. While working as a caddy, Peter was selected to participate in the Caddy Scholarship Program at Boston College. This was not just financial assistance. It was a doorway into a world many people from modest means never get to enter. At Boston College, Lynch studied business administration, but something else captured his attention: the stock market. He began buying shares, small at first. He invested not because he was told to, not because of textbooks, but because he simply found it fascinating. He read every annual report he could get. He studied every financial newspaper available to him. His curiosity did not switch off, not at night, not on weekends, not ever. In 1966, Lynch graduated, and soon after, he earned a master's degree from the Wharton School. And soon, the doors of Wall Street opened. Fidelity Investments, a young analyst begins. In the late 1960s, Fidelity Investments was not the giant it would one day become. It was growing, yes, but still finding its identity. Peter Lynch joined the firm as an intern, then as an analyst. He was assigned to research companies in the metals and mining sector. These industries are not glamorous. They are technical, cyclical, and global. They require patience, detail, and the ability to understand forces that seem invisible: commodity markets, political instability, technological change, human fear, and human hope. This was the perfect training ground. Lynch didn't just analyze balance sheets, he visited mines, he walked factory floors, he talked to workers, engineers, and executives. His research was not abstract, it was physical, tangible, real. And when he evaluated companies, he used a technique that would become one of the core pillars of his philosophy. Find out what the company does, then find out how they make their money, then find out why others haven't noticed it yet. Investing for Lynch was not guesswork, it was detective work. The Fidelity Magellan Fund, a sleeping giant. In 1977, something happened that would change Peter Lynch's life, and thousands of investors' lives as well. Fidelity offered him the position of portfolio manager for a small mutual fund called the Magellan Fund. It wasn't prestigious, it wasn't large, it wasn't considered strategically important. The fund held just $18 million in assets. Most professional investors would have declined such a role. It offered little recognition, little influence. But Lynch accepted, because he saw something others did not. He saw freedom. A small fund could move, it could adapt. It could go where opportunity existed, without being slowed by sheer size. No bureaucracy, no rigid strategy, just pure, flexible, responsive investing. It was, in a sense, a blank canvas, and Peter Lynch was prepared to paint something no one had ever seen before: the market landscape of the late 1970s. To understand what came next, we must understand the world Peter Lynch entered. The 1970s were marked by economic instability. Inflation was high, interest rates were rising, energy markets were volatile. Public trust in institutions was shaken. The stock market had stagnated for nearly a decade. Investors were cautious. Many believed the market was no longer a reliable engine of wealth. But Lynch did not see despair. He saw mispricing. He saw misunderstood companies. He saw opportunity. Where others saw chaos, Lynch saw value waiting to be revealed. And so, he began to build. One stock at a time. One industry at a time. One insight at a time. He would turn the Magellan Fund into what Forbes would later call the greatest mutual fund of all time. But that transformation would not come from bold, risky bets. It would come from something far simpler: observation, patience, and understanding how everyday life reveals financial truth. The philosophy begins to take shape. Lynch believed that the average person, teachers, nurses, mechanics, shop owners, could notice winning companies long before Wall Street analysts did. The sneakers teenagers were suddenly obsessed with, the restaurants that were always full, the household products that sold out faster than they could be restocked. These were not coincidences. These were signals. Signals that something was changing, that demand was rising, that a small company might soon become a large one. Lynch believed the stock market is not an abstract machine. It is simply the reflection of what people do every day. And the people who observe the world closely, truly closely, can see the future before others do. This belief would become his trademark approach. If you spend 13 minutes a year on economics, you've wasted 10 minutes. Meaning, the clues that matter are not hidden in macroeconomic predictions. They are hiding in plain sight, in grocery stores, shopping malls, parking lots, neighborhood conversations. A careful observer can see them. Peter Lynch was that observer. The power of compounding. A quiet force begins to grow. Lynch did not chase quick wins. He sought companies that could grow steadily, year after year, compounding value over time. Compounding is simple in definition, but profound in impact. If an investment grows at 29% per year, it doubles approximately every 2.5 years. And if you continue doubling, something extraordinary happens. Small investments become large. Large investments become immense. This is not magic, it is mathematics. But the patience required to allow compounding to work, that is the rare part. Lynch had that patience. And so, the Magellan Fund grew. $18 million. $100 million, $500 million, then more. Investors began to notice. Whispers traveled through the halls of Wall Street. Who is this quiet analyst from Boston? How is he doing this? Why does the Magellan Fund keep outperforming year after year? But Lynch didn't explain. He didn't boast. He simply kept researching, kept observing, kept refining the craft of seeing what others missed. Suspense builds. What comes next? Peter Lynch was only at the beginning of his ascent. The decisions he would make in the coming years would redefine what mutual funds could achieve. He would invest in unknown companies that would become giants of American life. He would study industries others ignored. He would change how millions of people think about money, risk, and opportunity. But greatness does not unfold in a straight line. It unfolds through tension, hesitation, doubt, and bold clarity. And as the global economy shifted, Lynch would face pressures that could have shattered everything he had built. The world was about to change, and Peter Lynch was about to change with it. Part 2. The Rise of the Magellan Fund. The year was 1977. The Magellan Fund, under the stewardship of Peter Lynch, was still small enough to move quietly, a small boat in a wide ocean. Yet the currents of global finance were turbulent, and few believed that extraordinary success could emerge from uncertain waters. But the story of Peter Lynch was never one of certainty. It was a story of attention, patience, and the power of seeing what others overlooked. This is the era in which the Magellan Fund began to rise. A rise not fueled by speculation or by trends, but by a single, relentless pursuit: understanding. The principle of the local edge. In the late 1970s and early 1980s, most investment professionals were trained to follow institutional research. Analysts relied on large data sets, complex models, and internal reports that told them which industries were safe, promising, or overvalued. But Lynch saw the problem. If 100 analysts were looking at the same information, then none of them would see anything new. He believed that new ideas come from the world outside the office. He encouraged investors to pay attention to stores that were always crowded, notice the products people recommended to friends, observe fast-growing neighborhoods and local businesses. This approach is now known worldwide as the Peter Lynch philosophy: invest in what you know. But this phrase is often misunderstood. It did not mean investing blindly in familiar names. It meant investing in companies you understand better than Wall Street does. A teacher might notice rising enrollment at a growing education services company. A nurse might see a pharmaceutical drug increasing in demand long before analysts notice. A homeowner might notice a home improvement company booming before earnings reports show it. The everyday world is a laboratory of financial truth, but only if one learns to observe. The hierarchy of company types. A new way to classify investments. To guide his investment decisions, Lynch developed a simple but powerful classification system. He categorized companies into 6 types. 1. Slow growers large, established companies with modest growth. Useful for stability but rarely transformative. 2nd. Stalwarts, well-established companies with steady earnings, reliable performers that could withstand recessions. 3rd. Fast growers, small or mid-sized companies with rapid, expanding sales. These held the greatest potential for extraordinary long-term returns. 4th. Cyclicals, companies whose earnings rose and fell with economic tides, such as airlines, steel, or automotive firms. 5th. Turnarounds, companies recovering from difficulty where public pessimism could mask future recovery. 6th. Asset plays, companies undervalued because their real assets, land, mineral rights, intellectual property, were misunderstood or ignored. This system offered clarity. It brought order to the overwhelming universe of publicly traded companies. And it gave Lynch the flexibility to move fluidly between industries and market cycles. The Magellan Fund didn't follow rigid rules. It followed opportunity wherever it lived. The expansion, from millions to billions. By the early 1980s, the Magellan Fund was no longer obscure. Word of its returns spread quietly at first, then rapidly. $500 million under management, then $1 billion, then $3 billion. Astonishing growth. But with size came difficulty. Large funds cannot move quickly. They cannot invest in small companies without influencing price. They cannot slip quietly into markets unnoticed. Most investors, when confronted with this challenge, slowed down. They became cautious, defensive, institutional. But Lynch refused to allow size to constrain discovery. He traveled continuously, nearly 300 company visits per year. He studied not only balance sheets, but parking lots. He believed the truth of a company is seen in how it lives, not how it reports. He visited factories in rural America. He walked store aisles in suburban shopping malls. He met executives in boardrooms and workers in break rooms. To Lynch, a company is not a ticker symbol. It is a living organism. And to understand it, one must see it with their own eyes. The 1980s, a decade of uncertainty and opportunity. The United States entered the 1980s under economic strain. Inflation was high, unemployment rose, consumer confidence fell, interest rates reached record levels, peaking above 18%. Many believed the stock market was too unstable to justify long-term investment. But history, as always, moves in cycles. In 1982, something shifted. The Federal Reserve began reducing interest rates to stabilize the economy. Businesses found breathing room. Consumers regained confidence. The stock market began one of the longest bull runs in American history. Most investors noticed only after it was well underway, but Lynch was already positioned. He had been buying carefully, steadily, strategically throughout the difficult years, because he understood something others often forget. Economic fear creates mispricing. Mispricing creates opportunity. Opportunity creates wealth, if one has the courage to act. And Peter Lynch had courage. Case studies, the companies that defined his success. During his tenure, Lynch invested in over 1,000 companies, but some stand as defining examples of his strategy. First, Dunkin' Donuts. At a time when many investors dismissed fast food chains as saturated industries, Lynch saw something different. He saw consistent customer loyalty, expanding franchises, steady revenue growth. Dunkin' Donuts became one of his most famous long-term holdings. His reasoning was simple. People will keep drinking coffee, they will keep buying small comforts. A business built on daily habits is a business built to endure. Second, Hanes. When Hanes introduced a new line of hosiery that became unexpectedly popular, Lynch noticed rising sales long before Wall Street reports reflected it. Because he talked to store managers. He observed retail behavior. He trusted first-hand information. This observation led to extraordinary profits. Third, Taco Bell Fast. Inexpensive, scalable. Lynch recognized the efficiency of the business model years before larger investors did. These were not speculative guesses. They were conclusions drawn from real-world evidence. In each case, Lynch did what he always did. Identify what was happening in everyday life. Understand why it mattered. Act before the crowd. The burden of success. As the Magellan Fund grew past $10 billion, something shifted. Attention, expectation, pressure. The financial media began to follow Lynch closely. Investors demanded explanations, forecasts, certainty. But certainty is not the language of markets. Lynch's advantage was his freedom of movement, the ability to buy small, undiscovered companies. Yet now, the world watched every action. More importantly, something internal was changing. The pace, the demand, the responsibility. Lynch worked nearly constantly, researching, traveling, reading, meeting, calculating. He slept little. He rested rarely. He had achieved what few dreamed possible, but at a cost that few understood. The personal dimension, a life beyond numbers. Peter Lynch was not a man consumed by wealth. He lived modestly. He spent time with his family. He donated extensively to charitable causes, especially education and healthcare. Yet the intensity of his work began to weigh on him. He had built a legendary career. But careers, no matter how brilliant, are not the whole of a life. His children were growing, time was passing, and the financial world does not slow down for anyone. He began to ask himself, is success measured in numbers, or in time, in recognition, or in presence? The world saw a rising legend, but Lynch saw a life moving quickly, too quickly. The turning point approaches. By the late 1980s, the Magellan Fund controlled more than $14 billion. It was the most successful mutual fund in history. The returns were unmatched. The reputation was global. But Peter Lynch was not finished learning, nor was he finished teaching. He would soon change how millions understand the stock market. He would write books that would influence generations of investors. He would redefine what it means to take control of one's financial future. But before any of that could happen, he would make a decision that shocked the financial world. A decision that few could understand at the time. A decision rooted not in markets, but in something far more human. Part 3. The legacy of a different kind of genius. The late 1980s were a moment of triumph for Peter Lynch. He stood at the summit of the financial world, celebrated, admired, and studied by professionals and everyday investors alike. The Magellan Fund now held more than $14 billion in assets. And it wasn't just the size that mattered, it was the performance. Over 13 years, Lynch had delivered an average annual return of nearly 29%, enough to turn a modest investment into something extraordinary. The financial world had rarely seen such consistency, year after year, in bull markets, in recessions, in panic, in euphoria. He succeeded not by predicting the future, but by understanding the present more clearly than others. Yet at the very peak of his influence, with the world expecting more, Lynch made a decision that stunned investors. He stepped away. The decision to retire. A departure few expected. In 1990, at just 46 years old, Peter Lynch announced his retirement from the Magellan Fund. There was no crisis, no scandal, no failure. He left at the height of his success. Some could not understand it. How could a man who achieved what most only dream of simply walk away? But Lynch saw something others didn't. He understood that life consists of chapters, and that to continue turning the same page is to miss the unfolding story. He wanted time. Time with his wife, Carolyn, time with his children, time to live beyond markets, numbers, and annual returns. Retirement was not an escape. It was a choice, a declaration that success is not only measured in performance, but in presence. And so, the greatest mutual fund manager of his era did something profoundly rare. He left before the world demanded his fall. The world reacts. Confusion and respect. Financial commentators were shocked. Some believed he would return. Others thought he was hiding something. Still others claimed the age of individual genius in mutual funds was coming to an end. But Lynch did not defend his decision. He simply began the next chapter of his life. He continued to work, quietly, thoughtfully, on something he believed in deeply: education. He wanted to help ordinary people understand investing for themselves, not to chase predictions, not to gamble, but to participate in the growth of businesses they truly understood. He believed that investing was not meant to be reserved for the elite. It was meant for everyone willing to learn. And so, he wrote, the books that changed how people invest. Over the next several years, Lynch published a series of books that have since become foundational texts in personal finance and investing. One, Up on Wall Street, 1989, Beating the Street, 1993, Learn to Earn, 1995. These books were not technical. They did not rely on formulas or jargon. They did not assume the reader had a financial background. Instead, they used simple language, clear examples, and everyday observations. Lynch explained investing in a way that felt human. Know what you own. Know why you own it. Be patient. Let growth take time. Ignore the noise. He encouraged people to trust their observations, to pay attention to the world around them, to believe that understanding business is not beyond the reach of everyday life. These ideas reshaped the way millions understood the stock market. The Lynch Way, a philosophy rooted in reality. Peter Lynch's approach was not magic. It was not secret. It was not reserved for a select group of insiders. It was grounded in principles that endure across generations. 1. The world offers clues. Pay attention. A full parking lot, a growing brand, a product people choose repeatedly. These are signs worth noticing. 2. Invest in what you understand. If a company's business cannot be explained in a few simple sentences, it may not be a wise long-term holding. 3. Companies grow, but expectations grow faster. The greatest returns come from companies that grow steadily, not from hype or trending narratives. 4. Patience is power. Compounding requires time, and time requires faith. 5. Markets move through cycles, and cycles require calm. Fear and exuberance destroy more wealth than market downturns. These principles have outlasted eras, recessions, booms, and technological revolutions, because they speak not to stock prices, but to human behavior. Philanthropy, purpose, and a life beyond markets. In retirement, Lynch directed his energy into philanthropy, especially in healthcare initiatives and educational programs. He funded scholarships, supported hospitals, strengthened research organizations, helped rebuild public institutions. He did this quietly, without spectacle, without the desire for legacy monuments or public recognition. Because Peter Lynch's legacy was never meant to be a statue. It was meant to be a way of thinking, a way of seeing, a way of living. What his story means today. Peter Lynch practiced investing during a very different era, before algorithmic trading, before high-frequency market activity, before the internet democratized financial access. But his lessons have only become more relevant. In a world of constant noise, endless forecasts, and digital speculation, his message remains clear. The stock market is not a casino, unless you choose to treat it like one. It is a mechanism through which the world grows, where businesses are born, where innovation expands, where patience is rewarded, and understanding pays dividends. Lynch showed that ordinary investors, people with no special training, no insider information, no Wall Street pedigree, can succeed. If they are willing to learn, observe, think independently, and trust their own judgment. This is not just an investment philosophy, it is a philosophy of life. Closing reflection. The meaning of mastery. True mastery is not loud. It does not demand attention. It does not announce its presence. It does not celebrate its victories. True mastery is quiet. It is the calm knowing, the steady hand, the patience to wait for others to see what you already understand. Peter Lynch became one of the greatest investors in modern history not because he sought greatness, but because he sought clarity. He observed, he learned, he listened. He trusted simplicity over spectacle. And in doing so, he revealed something profound. The world rewards those who are willing to pay attention.